Welcome to EXP Express Notes on CIMA P3 Performance Strategy. Today we are talking about interest rate swaps. This is another instrument that can be used by companies in the area of hedging interest rate risk. Last time we talked about interest rate futures and also forward rate agreements. In this case, the interest rate swap allows a party which may have, for example, fixed rate debt to swap the interest payments for that fixed rate debt to effectively borrow on a floating rate basis, and vice versa, a party which has floating rate debt on its books already can convert that into effectively fixed rate debt. Now, why would such parties want to do this? If we take a company that has fixed rate on its books now and is paying a fixed rate, if it believes that interest rates will be going down, it cannot borrow or benefit from the lower interest rates because of the fixed rate nature of its interest rate. Therefore, instead of repaying the fixed rate and drawing down new loans on a floating rate basis, it can do something much more practical and efficient. It can enter into an interest rate swap whereby it converts its fixed rate debt into floating rate. Same story would be true for a company that has floating rate debt and appears and observes that interest rates are going up, or fears that interest rates will go up, would also enter into an interest rate swap to avoid that event from occurring or from being affected by higher interest rates. Of course, the view on the market may turn out to be correct or wrong, but the point here is the companies involved in the interest rate swaps market are effectively hedging. They're trying to avoid downsides with regards to the interest rate exposure that they have. Of course, companies can also restructure their liabilities. This is another way in which they can enter into the swaps market. It doesn't have to be a one-way bet, one way or the other. They can mix their liabilities so that they have a desirable profile of both fixed and floating rate debt. Now, in arranging an interest rate swap, one has to define, of course, what the basis will be, the interest rate basis for a swap. A swap is the parties are exchanging with fixed rate moving in one direction and floating rate moving in the other direction. And therefore, the basis, the floating rate basis, has to be defined, whether it's, for example, 3-month dollar interest rates, 3-month LIBOR, for example, or whether it's 6-month sterling LIBOR as the floating rate. And then the fixed side defines what the fixed amount is to be paid under the swaps. Here's a simple example of two companies which could enter into a mutually beneficial swap arrangement. Company X borrows in both the fixed rate and floating rate markets at conditions cheaper than company Y. And even though X has unambiguously a better credit worthiness in both markets compared to Y, there is the possibility for X and both Y to be able to enter into a swap arrangement. If X were looking for floating rate finance, for example, and Y for fixed rate finance, then through a swap it would be possible for X to end up actually paying a LIBOR flat rate and Y to achieve a borrowing cost of 5.9% fixed. From this, it's a stylized situation, of course, and it's actually rare that one would have two companies that were standing opposite each other as counterparties to a swap arrangement. Generally speaking, each company is working with a bank as its counterparty and swap partner. If we move beyond interest rate swaps, there is also a active market in interest rate guarantees. This is another type of derivative which allows companies buying interest rate guarantees to be able to hedge interest rate risk. A borrower, for example, would be interested in buying protection against higher rates. So if a borrower had an interest rate guarantee which protected them from paying no more than 7% for their loans, if the market were to go above 7%, then the borrower would trigger the guarantee and receive compensation, the difference on the rise in rates. On the other side, however, the borrower would benefit if rates went below 7%. That's what we mean by an option. The option effectively allows a participant in this market who buys the option and pays a premium to basically have their cake and eat it. In other words, they are protected against, a borrower would be protected against higher borrowing costs, but if interest rates were to go down, they could benefit from the lower interest rates. So this option has an asymmetric sort of payoff connected to it. Once one has straightened out the strategy, what it is that a company wants to achieve by entering into or purchasing interest rate guarantees, then the rest of the discussion really is one of terminology. Borrower's option, a lender would buy a so-called put option, and position takers, these would be market actors who are not seeking to hedge an interest rate exposure, but willing to take on an exposure based on a belief on which way interest rates are moving, may enter in the options market as well to purchase or to sell interest rate guarantees. Interest rate options can be traded on exchanges. The interest rate guarantees we saw on the previous page can be bought and sold from banks as counterparties through an over-the-counter market. So the array of instruments, derivative instruments, available for protecting against interest rate risk are many, and it's important for a company to first of all understand what their exposure is in the interest rate market, and secondly what their response will be to that exposure. If they wish to hedge the exposure, then the third step is they have to implement the hedge by selecting the appropriate hedge strategy and to find the right solution to mitigating the interest rate risk. Now, the next area we want to talk about, in addition to interest rate risk, is, of course, foreign exchange risk. This is a well-known area and oftentimes very familiar to most students, either from personal experience or simply being aware of the volatilities in foreign exchange rates that one reads about in the newspapers. Now, before we look at foreign exchange hedging instruments, in other words, instruments, financial instruments that are available to protect oneself against foreign exchange risk, let's just look at three categories of risk. We're speaking primarily in the context of this paper about transaction risk. This would be the cash gains and losses that a company would experience if they were involved in importing and exporting goods, settling their bills in foreign currencies, borrowing in foreign currencies, investing, and so on, cross-border. So these are short-term transaction-oriented transactions that expose a company to a real cash gain or loss. Now, economic risk is something we don't talk about from a transaction orientation, because economic risk is referring to something much more general. It's the long-term impact of foreign exchange movements on the financial situation of a given company. This is long-term. If one builds a factory, for example, in a low-cost country, those assumptions and the business model in which one is betting to be able to benefit from low production costs over a number of years depends crucially on the currency of that host country of the manufacturing concern not to be revalued or experience a strong appreciation. Otherwise, that would knock out all of the long-term planning assumptions that were made. Also, interestingly enough, economic risk is relevant to virtually all companies, including companies that may be operating domestically, purely domestically in their local market, but may be subject to a threat from foreign-produced cheaper exports. The third area of translation risk is much more familiar, of course, to accountants, because this is referring to the on-paper gains and losses which occur through translating assets and liabilities of foreign-owned subsidiaries and affiliates as they get consolidated into the parent company's consolidation in the parent company reference currency. So this is not something which involves cash or transactions, but is simply a translation difference. But of course, it's something which is also relevant for international groups as they consolidate their statements to understand what the impact will be of a change in foreign exchange rates. Thank you.